What if you never had to work another day in your life and the money just kept flowing in every single month like clockwork? That is not a fantasy. That is exactly what dividend investing can do for you. And today I am going to show you the three fastest paths to pulling in $3,500 every single month purely from dividends. Stay with me because by the end of this video, you will have a clear roadmap that most people never get to see. Before we jump into the strategies, let's make sure we are all on the same page about what dividends actually are. When you buy shares in a company, you become a part owner of that business. When the company earns profits, it has a choice. It can pour that money back into expanding the business, or it can distribute a portion of those earnings directly to shareholders. That distribution is called a dividend. You do not have to sell anything. You do not have to do any work. The money simply arrives in your account, usually every quarter, sometimes every single month. Now, the key metric you need to understand is dividend yield. That is just the annual dividend payment divided by the stock price, expressed as a percentage. So, if a stock trades at $100 and pays $10 in annual dividends, your yield is 10%. That number is everything when it comes to figuring out how much you need to invest. Now, here's where it gets really interesting. To earn $3,500 per month, you need $42,000 per year in dividend income. If you were chasing traditional dividend stocks yielding around 2%, you would need over $2 million invested. That feels impossible for most people. But these three strategies completely change the math. Let's get into them. Strategy number one is covered call ETFs. This is genuinely one of the fastest routes to dividend income that most everyday investors have never heard of. A covered call ETF holds a portfolio of stocks, but here's the twist. It also sells call options on those same stocks. When the fund sells those call options, it collects what is called option premium. And that premium gets distributed to you as income on top of any regular dividends. The result is an extraordinarily high yield that traditional stock investing simply cannot compete with. Some of the popular covered call ETFs out there carry trailing 12-month yields approaching 12% or even higher. At roughly 12% yield, to reach your target of $42,000 annually, you would need an investment of approximately $360,000. Compare that to over $2 million with standard dividend stocks, and you can see why this strategy is so powerful. The trade off is that you sacrifice some upside growth when stock prices rise sharply because the fund may have to sell shares at the predetermined strike price. But if your goal is income now rather than maximum capital appreciation, covered call ETFs are a genuine game changer. Strategy number two is high yield real estate investment trusts, or REITs. A REIT is essentially a company that owns income producing real estate, things like apartment complexes, office buildings, and shopping centers. By law, REITs are required to distribute at least 90% of their taxable income to shareholders, which is precisely why their yields are so much higher than typical stocks. Some high yield REITs have been known to offer dividend yields approaching 20%, though those ultra high yields do carry meaningful risk and can fluctuate depending on property vacancy rates and broader economic conditions. Using a more conservative blended yield estimate of around 11% for a diversified REIT portfolio, you would need roughly $380,000 invested to hit your $42,000 annual income target. One particularly attractive feature of REITs compared to most stocks is that many of them pay dividends monthly rather than quarterly. For someone trying to replace a paycheck, getting that deposit every single month is a major psychological and practical advantage. The key is to diversify across multiple REITs rather than betting everything on one, which helps smooth out the volatility that individual REITs can experience. Strategy number three is dividend aristocrats. Now, this one takes a bit more capital, but it offers something the other two strategies cannot always guarantee, and that is rock solid reliability. Dividend aristocrats are companies in the S&P 500 that have increased their dividend payments for at least 25 consecutive years in a row. Think about that. Through recessions, market crashes, and economic storms, these companies kept raising their dividends every single year without exception. These are battle-tested businesses, typically large, well-established corporations from diverse industries that tend to hold up better during economic downturns. The average dividend yield among aristocrats runs around 7%. At 7% yield, to reach $42,000 per year, you would need to invest approximately $600,000. That is more than the previous two strategies, but the reliability and long-term dividend growth you get in return is genuinely unmatched. Your income does not stay flat either. Because these companies consistently raise dividends each year, your $3,500 per month today could quietly grow into $4,000 or $4,500 monthly over the next several years without adding a single extra dollar of your own money. So let's put this all together. If you want the fastest path with the least capital required, covered call ETFs get you there first. If you want monthly income with real estate exposure and strong yields, high yield REITs are your best friend. And if you want the most dependable, sleep well at night strategy that grows over time, dividend aristocrats are the gold standard. The smartest approach for most people is actually blending all three, giving yourself both high current income and long term stability. The dream of waking up every morning knowing your bills are covered without ever clocking into a job is absolutely achievable. These three strategies are your fastest lane to getting there. If you want to go even deeper on similar topics, click the subscribe button now. Your financial freedom journey starts today, so don't wait.